Hello, everyone. Steve Ankerstar here, and thank you so much for listening in. Today, we're going to talk about the risk unit. You'll hear me talk in terms of setting R, making 3R, risking 1R. So we're going to talk about exactly what that is. We're going to take it a little slower pace than we do in the daily morning brief, where we talk about things very quickly. So this is a great place for you to kind of brush up on the concept of risk unit, and you really need to have complete understanding of this before you proceed. If you're paper trading, that's fine. You can go in there and you can kind of learn on the fly, if you will. But certainly if you were going to commit real money to this, you would want to completely understand what the risk unit is. So there's my information. There's my disclaimer. This is financial education only. Do what you want with it. And let's get started with, in the room, we run the daily day trading challenge, and here's how it works. I wanted to cover this real quick just so you can see how R is used in a conversation. So most of you know the top part, financial education only. You get down to the daily day trading challenge. You're going to pick a stock, go long or short, and set your R. So there's our R that we're going to talk about today. That risk unit can be dollars or a stop limit. It's the same thing. You're translating dollars into a stop limit, so when you're in the execution phase, you understand how far the stock either can move before you have to get out or needs to move before you make the appropriate level of gain to make it worth the trade. So that's why we make that translation. I will give you the verbiage behind it and walk you through a couple of examples. And I will also give you an Excel spreadsheet that I need to hang on the OTOT Now website. I will do that today, figure that out. So you can download it, so you can play with this on your own. It's not complex, but until you understand exactly what it's saying, it can be a little bit challenging. And then of course there you're measured in the number of R at the end. So there's our R again, just that's a quick review. Okay, how to set your R. Let's back up for a second and think about if you were to do this for real money. You would think to yourself, this is basic money management, whether you are investing, or whether you are a poker player possibly, or a gambler. It's basic money management. So if you say you had $10,000 and you were going to get into day trading, you probably wouldn't want to put $10,000 down on the trade on the first day, because you could lose it and then you'd be done. That would be stupid. So what's the appropriate amount of risk to use? If you have a $10,000 account, you should use probably, you should paper trade first of all. But if you're going to use real money because you can't help yourself, or you are confident going in that you know what you're doing, then I would say you would want a bankroll, if you will, of about 100 R. So if you're going to have 10,000 in your account, you should use a risk unit at about $100. If you have your 25,000 in your account, stand by. If you have the 25,000 in your account, then you could use a 250 R. That would again be 100 risk units in your account. So another way to look at it is, if you don't have a bankroll, if you will, if you think of it from a daily perspective, it's like, how much do I really want to risk out of my money to try to become a day trader? Well, I tend to tell folks you would not want to risk more than whatever you make in a day. So if your hourly wage is say 40 an hour and you work for an 8-hour day, that would be $320 a day that you're getting paid. So you would not want to risk more than 320 for sure. In the day trading world, things happen very quickly. You can be out of a trade in a matter of seconds, and you can also make 3 times your R in a matter of seconds. So it just moves very quickly. That's why you have to know exactly what you're doing and take the right amount of risk. If you don't care about your trade, you're taking too little risk. If you're sitting there freaking out at the keyboard and you start shaking or sweating or crying or whatever it is your mechanism is for dealing with stress, or you want to put some vodka in your orange juice at 8 in the morning, all of those things are signs that you're holding on way too tight and you're taking too much risk. So all of those factors, whether you're doing bankroll math, daily math, whatever your stress level is, you want to have the appropriate risk unit. I will use the example of a poker game. if you are a poker player, you you normally pay in $100 buy-in game and you're the best player there, then that's what you're used to. If you try to play with your children, not that you should, just as an example though, and you're playing a nickel dime game, you may not have the appropriate level of interest to play proper strategy. And you might bail on your strategy and you'll probably lose. You're like, that's weird. It's because you abandon your strategy because the risk is too small. If you walked into a game with your local crew, your uppity up crew, and it's $1,000 buy-in, and you're out of your comfort zone, you also may not play your optimal strategy and can lose. It's the same game, same math involved, but yet at differing levels, you may not be able to actually execute your optimal strategy, and that's all because of your emotions. So that's enough philosophy on that. Look at the bottom there. Whenever you decide your risk unit, and I'm using $100, and then I will use an example using a $10 stock. Just to keep the math simple. Obviously, if you get away from the even tens and hundreds, things can get a little more confusing very quickly. If you wake up in the morning and you say, I want to risk 1R, and that R is going to be $100. If you were to buy shares of a stock, you'd have to look at how much you have in your account. And if you can afford to buy 1,000 shares or short 1,000 shares, then you could use a 10-cent stop. So 1,000 shares and it moves 10 cents. If it moves in your direction, you can keep going up to 30 cents. That would be your 3R. If it moves against you, whether up or down, if it moves against whatever trade you're trying to do and you hit your R limit, you're done. You have a stop limit set and you're out. You're only risking the 1R. If you don't put the limit in and you get disconnected from the internet, you could take all kinds of wild losses and you will never forget that experience, but that's a very experienced lesson. So take this one for free. So that's a 10-cent stop. If the stock is flopping all around and going up and down 10 cents like every few seconds, then that would probably be too close of a stop for you to put in. So you'd want to only buy 500 shares. Since you have 500 now instead of 1,000, you can double your stop. So now you can accept a 20-cent stop, meaning the stock, if it moves against you 20 cents, you are out your 1R unit, in this case of 100. But if it works for you, it now has to move 60 cents in your direction for you to make your 3R, which again is your goal with the system I'm using. 250 shares, maybe the stock price is now higher to where you can only afford 250 shares. Well, if you can only afford 250 shares, you need it to move 40 cents to make your R. And again, $1.20 now to make your 3R. And if you say it's an expensive stock and you can only afford 100 shares, then you put the stop right at $1. It's far more important that you're controlling the risk on the downside than it is what you're making on the upside. So this is all about risk management to the downside. When you look at this in Excel form, and this is nothing cosmic here, it's just putting in what you're actually thinking into an Excel spreadsheet. And you may need this open in front of you. Again, I'll figure out how to hang this on the website. One of the squadron members came up with this, so thank you. And you put your risk unit up top, and that should not change on a daily basis. So, you should think about that and then come up with it and put it there, and it should not change. The actual money available in your account, you put it in there. If you are just starting out in a margin account, you get 2 times margin just for signing up. Once you become a pattern day trader, which we talked about in the last case, or your paper trading, I think you can set it to 4x. But if you were to do this in the real world, after you become a pattern day trader, after taking a few trades over 5 days, then you get a 4 times margin. So that gives you those top 2 numbers multiplied against each other, gives you your total money available. So you have to consider that when you're going to buy. If you were to buy 1,000 shares, then you cannot buy, it can't be over $25 per share because you wouldn't have enough money in your account to execute that. Hopefully that makes sense. The light blue area there is the stock price. This is by far the most important thing. So when you start to take a trade and you don't want to do the math in your head, which I recommend you don't right away until you have a complete grasp of the math, go ahead and put your stock price in there. That's what it's for. That's the input function in this Excel spreadsheet, hence why it's in blue. Once you put your stock price in there, you figure out in the buy line or the short sell line. You figure out if you're going to take a trade for the stock increasing or decreasing, and it tells you which chart to go to. In the case where we are going to go long, we are going to buy this stock, and we are going to, going across the top line there, we are going to buy 1,000 shares of a $10 stock, which will cost us $10,000. So you look quick up to the right. Can I do that? Yes. Okay, no problem. The stop to the bottom downside is minus 10 cents. So you would set your stop limit at $9.90. And then you have the percentage move, which is also enlightening, meaning if the stock drops a percent, which is stocks do that on a daily basis, especially one that's in play, that's the margin you have to the downside before you get stopped out. So you may or may not want it at 1%. So that's what it gives you, all the math you need there. And then it tells you this is before you ever enter the trade. This is while you're thinking about entering the trade. And then you look at the green part, it's the, okay, if I'm going to make money, I need 3R. I need this thing to move up 30 cents. So there's the price. It would need to go up to $10.30. It would need to move up 3% in really the first 20 minutes of the day, or whatever your time. For the day trade challenge is 20 minutes, but for whatever your trade is, you're only, if it moves that fast, if it pops, then you can be back out of the trade with 3R very quickly. If you don't like those numbers, if you want a bigger stop, then only buy 500 shares. It only costs you 5,000 out of your account, and you set a 20-cent stop. So you have all the way down to 980. You can see the numbers there. And if you want a 40-cent stop, you can only buy 250 shares, and then you have all the way down to 960 before you get stopped out. So you have basically a 4% pad. Now, if you look what it's going to take to get your 3R on the right, is it's going to have to go up $1.20. So does the stock, before you take the trade, have the potential to go from $10 up to $11.20, which is a 12% move up in the first few minutes? Generally, that's tough on the long side. However, let's talk about short selling. This is where you have to look in the mirror. This is where you have to back up the trailer. You have to kind of think of everything backwards. Again, our stock price is $10. We're going to short sell it, which means we're going to borrow the stock and sell it. There will be a story for another day on exactly how that works. But basically, you enter your trade ticket of I want 1,000 shares and short sell, and hit enter. And it will cost you $10,000 to do that. You're basically borrowing the shares and selling them. You'll have a minus share count if you've never seen that. And you are counting on the stock going down. So since you're counting on the stock going down, the part in red is if the stock moves against you. If it moves against you, that means it's going up. So your risk unit with 1,000 shares, it'll cost you $10,000. Do I have that in the account? Yes, I do. And then I will get, if it moves up to $10.10, then I'm out and I'm done for the day. That's my 1R. That would only be a 1% move. So you can see how the numbers are different, but the stock move percentages are the same. If you had 500 shares, or excuse me, 500 shares, that would cost you $5,000. Now you have a little bit more cushion in your stop, all the way up to 1020. You can tolerate a 2% move up before the stock rolls over. And sometimes you'll see that at the beginning. You'll see a short covering to where a stock that is gapped down overnight will now pop at the beginning before it rolls over. So you do want to give yourself a little bit of cushion to the upside. There's times to take a 10-cent stop. There's times to give yourself a little more cushion. But that's all in a strategy. And then the last one there is 250 shares. If you have 250 shares, it's going to cost you $2,500. Now you have a 40-cent stop. You have a nice stop to the upside. That's 4%. But then, of course, the stock has to drop down another 12% from where it is for you to make your full 3R. When you're in a short, this can happen very quickly. It's tough for that kind of move to happen to the upside. So you end up either not getting your full 3R or just killing the trade at 2R. But if you're in a short sell situation and a stock starts to roll over where people are selling it, then it can continue down quickly. How does that happen? It's when institutions sell. It's not you and me holding 1,000 shares or 5,000 shares. It's when the JP Morgan trading desk dumps this thing, or the Harvard Endowment Fund. they hit a lower limit on a stock, say it's a negative headline like um, um, Luckin Coffee comes to mind, so that really wouldn't be in an endowment fund. But let's talk General Electric. General Electric, big, nice, safe stock. All of a sudden, it starts getting some negative headlines out there, and an endowment says, they have a board meeting, and they're like, we got to get out of this thing, and they have to move 1 million shares. Even if they're getting it worked into the market, which they would pay a market maker to basically feed it in slowly. That's where you're going to get that big move to the downside, is they just have to get rid of it. So, and you can see that in the level 2 orders. I'll show that if I can ever find a good example of fire selling of a stock. So that's what I've got for you today. Thanks for listening. I hope you understand a little bit more about risk unit. It's something to probably listen to maybe more than once, especially depending on your math skills. But once you have your arms around the risk unit, then you're basically minimizing your loss. So, from either an investment strategy, long-term, or a day trading strategy, or buying a house, or, getting into a business, most, smart investors think about how much can I lose first, think about that, and then let the upside take care of itself. So with that, I will leave you until next time. Thanks again for listening.